What most people believe about gold, silver, and stock market crashes is dangerously incomplete. That misunderstanding is exactly what causes investors to panic at the worst possible moment. Because when markets fall sharply, gold and silver do not behave in a simple straight line way. They don't just go up instantly, and they don't always protect you on day one. Instead, they move through very specific phases that repeat across history. And if you don't understand those phases, you'll misread the signals, sell at the wrong time, or completely miss why precious metals end up outperforming when it matters most. So, in this video, we're not making predictions. We're not selling fear. And we're not telling you what to buy or sell. We're doing something far more valuable. We're looking at what actually happened to gold and silver during real market crashes, using hard historical data, real timelines, and real behavior from past crises. So you can understand what tends to happen, why it happens, and what most people get wrong when volatility hits. And by the end of this, you'll understand why precious metals often disappoint people at the beginning of a crash, but reward patience later in ways few other assets can. To start, you have to understand one critical truth that almost nobody talks about during market sell-offs. In the early stages of a stock market crash, almost everything gets sold, including gold and silver. This is not a theory. This is a historical pattern. When fear spikes suddenly, investors don't calmly rotate. Portfolios, they raise cash. Hedge funds face margin calls. Institutions sell whatever they can sell quickly. Retail investors panic and liquidate. And because gold and silver are liquid, globally traded assets, they often get sold alongside stocks in the initial phase of a crash. This is why people are always shocked when gold dips during the first wave of a market collapse. They expect gold to immediately surge, but that expectation ignores how modern financial markets actually function under stress. The first phase of a crash is not about safety, it's about liquidity. And liquidity means cash. This exact behavior was visible during the 2008 financial crisis. In the early part of 2008, as financial stress began building, gold initially fell. Silver fell much harder. From March 2008 to October 2008, silver dropped by more than 50%. Gold declined as well, though far less severely. And this caused many investors to conclude that precious metals had failed as a hedge. But that conclusion was premature because they were only looking at phase one of the crisis. Once forced selling subsided and the real economic damage became visible, the behavior of gold and silver changed dramatically. From late 2008 into the years that followed, gold entered one of the strongest bull markets in modern history, eventually rising from around $700 per ounce to over $1,900 by 2011. Silver followed, climbing from under $9 to nearly $50. The same asset that disappointed people at the beginning became one of the best performers over the full cycle. This pattern repeated again in 2020 during the co-shock. In March 2020, when global markets collapsed, gold fell sharply for several days. Silver collapsed even harder, dropping over 30% in a matter of weeks. Again, people said gold had failed. Again, they were wrong. Once central banks stepped in with massive monetary support, once liquidity returned and once real yields collapsed, gold surged to new all-time highs by August 2020, while silver more than doubled from its lows. The key lesson is this: precious metals are not designed to protect you from panic. They are designed to protect you from what comes after panic. What comes after panic is almost always aggressive policy response. To understand why gold and silver eventually benefit from stock market crashes, you have to understand what governments and central banks do when markets break. Historically, severe market crashes force policymakers into the same playbook. Interest rates are cut aggressively. Liquidity facilities are expanded, balance sheets grow, deficits rise, debt issuance increases. In other words, financial stability is restored by injecting money into the system. This is not ideological, it's mechanical. When the financial system is at risk, stability takes priority over long-term discipline. And this environment is where gold and silver thrive. Gold is particularly sensitive to real interest rates, which are interest rates adjusted for inflation. When real rates fall or turn negative, holding cash or bonds becomes less attractive, and gold becomes more competitive despite offering no yield. Silver benefits both as a monetary metal and as an industrial metal, especially when stimulus-driven recoveries boost manufacturing, infrastructure, and energy investment. This is why gold and silver tend to lag at the beginning of crashes, but outperform in the recovery and policy response phase. Another important point that is often misunderstood is that gold and silver do not hedge against falling stock prices directly. They hedge against systemic risk, currency debasement, and loss of confidence in financial assets. Stock prices can fall for many reasons, including tightening financial conditions, rising rates, or valuation corrections. In those scenarios, gold may not immediately shine. But when stock crashes threaten the stability of the financial system or the credibility of monetary policy, That's when gold's role becomes most apparent. This distinction matters because not all crashes are the same. A valuation-driven correction driven by rising rates is very different from a credit-driven crisis or liquidity crisis. Gold performs best when the response to the crash involves suppressing rates, expanding money supply, or socializing losses. Silver, while more volatile, tends to amplify these dynamics once confidence in recovery builds. It's also important to recognize that silver behaves differently from gold because of its dual role. Silver is both a monetary asset and a critical industrial input. This means that during the early stages of a crash, silver often falls more sharply than gold because industrial demand expectations collapse. But during recovery phases driven by stimulus, infrastructure spending, and industrial expansion, silver often outperforms gold significantly. This volatility makes silver emotionally difficult to hold during crisis, but historically rewarding for those who understand its role in the cycle. Another factor that influences precious metals during crashes is the behavior of the US dollar. In global crises, the dollar often strengthens initially as investors seek safety and liquidity. This can temporarily pressure gold and silver prices since they are priced in dollars. But once policy responses weaken the dollar through rate cuts and balance sheet expansion, gold and silver often benefit. This dynamic played out clearly in both 2008 and 2020, and it remains one of the most consistent drivers of precious metals over time. Now, let us address a common misconception that causes many investors to lose trust in gold and silver during downturns. Many people believe gold is supposed to go up every time stocks go down. That belief sets unrealistic expectations and leads to frustration. Gold is not a day-to-day inverse trade of stocks. It is a long-term hedge against systemic stress, monetary instability, and loss of purchasing power. When you judge gold over days or weeks during a crash, you miss its function entirely. When you judge it over full cycles, including the policy response and recovery, its role becomes clear. This is why institutional investors, central banks, and sovereign funds view gold differently from retail traders. They don't expect immediate protection. They expect long-term balance and resilience. Central bank behavior during crisis reinforces this point. During periods of financial stress, central banks around the world tend to increase gold reserves, not decrease them. They view gold as a neutral reserve asset that carries no counterparty risk. This behavior is not speculative. It is strategic, and it provides an important signal about gold's soul when confidence in the financial system is strained. Silver, while not held by central banks in the same way, benefits indirectly from this environment as monetary expansion and fiscal stimulus raise demand across real assets. As we move deeper into this topic, it becomes clear that the real value of gold and silver during stock market crashes is not in predicting the crash itself, but in understanding the response to it. Markets can fall for many reasons, but the response to falling markets tends to follow a familiar pattern. Policymakers ease, currencies weaken, real yields fall, and confidence in paper assets is tested. Gold and silver are positioned not for the shock, but for the aftermath. That distinction explains why they often feel disappointing at the worst moment emotionally, yet powerful over time. In the next part, we'll go deeper into specific historical timelines, compare different types of crashes, examine how long it typically takes for gold and silver to outperform after market bottoms, and explore why investor psychology often works against holding precious metals at exactly the wrong time. We'll also look at how modern market structure, derivatives, and ETFs have changed short-term behavior without changing long-term outcomes. That's where the real insight begins. To fully understand what happens to gold and silver when stocks crash, you also need to understand timing, because timing is where most people get psychologically trapped. Investors tend to think in headlines and daily price moves, but crises unfold in stages, and each stage produces different behavior across asset classes. After the initial liquidation phase passes and forced selling subsides, markets enter a period of stabilization where volatility remains high, but panic selling slows. This is often when gold begins to recover quietly, even while stocks continue to struggle. Historically, gold tends to bottom before equities, not after them, because gold responds to expectations about policy rather than earnings or growth. Once markets begin to anticipate rate cuts, liquidity injections, or fiscal stimulus, gold often starts moving ahead of the visible economic recovery. Silver, on the other hand, usually lags gold at this stage because industrial demand remains weak while uncertainty is still high. This lag is another reason investors lose patience with silver too early. But as stabilization turns into a stimulus-driven recovery, silver often accelerates sharply, sometimes outperforming both gold and equities over the next phase of the cycle. This sequence has repeated across multiple crises, not because of coincidence, but because of how financial systems are designed to respond to stress. One of the most Overlooked dynamics during market crashes is how debt behaves. Modern economies are highly leveraged, and when asset prices fall sharply, debt does not disappear. It becomes heavier relative to income and asset values. This increases the real burden of debt and raises the risk of defaults. Policymakers respond by lowering borrowing costs and expanding credit availability to prevent a debt deflation spiral. These actions directly benefit gold by suppressing real interest rates and indirectly benefit silver by stimulating demand for real economic activity. This is why gold and silver tend to benefit not from the crash itself, but from the policies required to manage the aftermath. Another important factor is confidence. Market crashes often expose weaknesses that were ignored during periods of expansion. These can include excessive leverage, fragile banking systems, overvalued assets, or unrealistic growth assumptions. When confidence in financial institutions or policy frameworks is shaken, gold benefits because it represents an asset outside the financial system. It does not rely on a promise to pay. It does not depend on earnings. It does not carry counterparty risk. Silver shares some of these attributes, but because it is also consumed by industry, its price reflects both monetary and economic expectations. This dual nature makes silver more volatile, but also more responsive. During recoveries driven by real investment. Another misconception that deserves correction is the idea that gold and silver are only relevant during extreme collapses. In reality, many of their strongest periods of performance occur not during full-blown crises, but during prolonged periods of financial repression that often follow them. Financial repression refers to a policy environment where interest rates are kept artificially low, inflation runs above yields, and savers lose purchasing power over time. This environment does not feel dramatic day to day, but it steadily erodes confidence in traditional savings vehicles. Gold performs well in this environment because it preserves purchasing power over long periods when real returns elsewhere are negative. Silver benefits because financial repression often coincides with infrastructure investment, energy transitions, and industrial expansion, all of which increase silver demand. Understanding this context is crucial because many investors mistakenly focus only on crash scenarios and miss the longer, quieter phase where precious metals tend to do much of their work. Another layer to consider is how modern financial instruments affect short-term price behavior without changing long-term fundamentals. The growth of ETFs, futures markets, and algorithmic trading has increased short-term volatility in gold and silver. During crashes, these instruments can amplify selling pressure as positions are unwound rapidly. This can make gold and silver appear less stable in the short term than they were in earlier decades. However, these same instruments also allow capital to flow back in quickly once conditions stabilize. The result is greater short-term noise, but similar long-term outcomes. Investors who focus too closely on short-term price action often misinterpret this volatility as failure, when in fact it reflects the mechanics of modern markets rather than a breakdown of gold's role. Another aspect worth examining is relative performance. During stock market crashes, gold often does not outperform cash in the very short term because cash becomes scarce and valuable. However, over medium and long horizons, cash tends to lose value as policy responses debase currency purchasing power. Gold's role is not to beat cash during the panic, but to protect against what happens after cash loses its temporary advantage. Silver's role is even more misunderstood because it is rarely viewed as a monetary hedge first. Yet, history shows that during periods of sustained monetary expansion, silver can outperform gold due to its smaller market size and industrial leverage. This outperformance is not guaranteed, and it comes with volatility, but it is a recurring feature of post-crisis environments. One of the reasons precious metals often feel uncomfortable to hold during crisis is because they do not provide immediate feedback in the form of steady gains. Stocks either crash or rebound. Bonds either rally or sell off. Gold and silver often move sideways for long periods before breaking out. This lack of immediate gratification tests investor patience. But patience is precisely what precious metals reward over full cycles. The investors who benefit most from holding gold and silver during crashes are not those who trade them actively, but those who understand their role as part of a broader portfolio designed to survive multiple economic regimes. This brings us to an important distinction between speculation and allocation. Speculators attempt to time short-term moves. Allocators focus on long-term balance. Gold and silver function best as allocations, not as trades. When investors treat them as short-term hedges against daily stock moves, disappointment is almost inevitable. When they treat them as long-term stabilizers in a world of growing debt, recurring crises, and policy intervention, their value becomes clearer. Another historical example reinforces this point. During the inflationary period of the 1970s, stocks experienced multiple severe drawdowns adjusted for inflation, even when nominal prices eventually recovered. Gold and silver, by contrast, delivered substantial real returns over the decade, despite periods of volatility and corrections. This performance was driven not by fear alone, but by sustained monetary expansion, negative real rates, and loss of confidence in fiat currency. While no two periods are identical, the structural similarities between past and present environments help explain why gold and silver continue to play a role in modern portfolios. It is also important to address expectations around correlation. During extreme stress, correlations across assets tend to rise, meaning diversification benefits temporarily weaken. This is why gold may fall alongside stocks during initial crash phases. However, as conditions normalize and policy responses diverge across asset classes, correlations tend to fall again. Gold often regains its diversification benefit during these later stages. Silver's correlation tends to remain higher due to its industrial component, but it can still provide diversification over longer horizons. Investors who judge diversification based on short-term correlations often misunderstand how portfolios behave across full cycles. Looking ahead, the most realistic expectation for gold and silver during future market crashes is not immediate protection from volatility, but eventual protection from policy consequences. Markets crash for many reasons, but they're almost always stabilized through intervention. That intervention reshapes the financial landscape in ways that favor hard assets over paper promises. Gold responds first to these changes. Silver follows with greater volatility and often greater upside during recovery phases. Neither asset eliminates risk. Neither asset guarantees gains, but both have demonstrated an ability to preserve purchasing power and outperform traditional assets over long periods marked by instability and intervention. The most important takeaway from this analysis is not a prediction, but a framework. When stocks crash, the right question is not whether gold and silver will go up tomorrow, but how the response to the crash will affect currencies, interest rates, debt, and confidence over time. Gold and silver are tools for navigating that environment, not for avoiding discomfort entirely. Investors who understand this framework are less likely to panic, less likely to sell at the wrong time, and more likely to benefit from the structural forces that follow crises rather than the emotional chaos that accompanies them. In a world where financial shocks have become more frequent and policy response is more aggressive, understanding how different assets behave across full cycles is no longer optional. It is essential. And while gold and silver may not always move when you expect them to, history shows that when markets break and systems are stressed, they tend to matter far more than people realize at the moment they are most doubted.